quantitative investing. If when I say those words you picture giant screens in a New York office, men in suits typing frantically, or some dude running Python in his mother's basement to lose money in fashion, then you're right. I myself spend my days with 2 monitors. Fancy, right? Wrong. I don't even make investment decisions. Unbelievable. But in all seriousness, we would consider what we do quantitative investing. But what exactly is quant investing? Although quant investing could look pretty cool, like it does in the movies, it could also be much, much simpler than that. Maybe it's simpler than it looks, and maybe you too could use it to your advantage. For our purposes today, we'll refer to quantitative investing as rules-based investing. And that could mean multiple things. For instance, a short-term quant trader could run models to take advantage of discrepancies in the market. Traders like Jim Simons, who was said to have solved the market, used high-frequency trading models to make astronomical profits. But this type of trading takes insane amounts of capital, both human and economic, to run successfully. I mean, Simons himself had a PhD in mathematics from Berkeley and became a professor at MIT. The man was extremely intelligent and dedicated his whole life to quote-unquote solve the markets. The point here is for me to convince you to more than second guess yourself if you think you could potentially run something like Simons. Selling 0 DTE options on Robinhood is just not going to cut it. That, however, does not mean that everyday investors are not able to either buy or run their own quantitative investing strategies. Let's go back to our definition. Quant investing means running rules-based strategies. More specifically, systematic investors look at the evidence and then build models that follow that evidence in an attempt to generate alpha. Some quants like Simons found their own evidence. Others can rely on evidence that is widely available to the public. Wait, Jose, if this evidence is already available to the public, why should these strategies even work? Wouldn't they just have been arbitraged away? Well, think about it like this. If the average investor is not smart enough like Simons to beat the market, which, let's be honest, most of us are not, then the only hope for us is to implement strategies that Wall Street cannot implement. But why can't they? Well, because they require steadfast discipline and long time horizons. See, the world runs on getting instant results. People want to get rich quick. They want things done now. And that does not exclude investment boards. Money managers can easily lose their jobs if they underperform the market, even in the short term. In the paper, Even God Would Be Fired as an Active Investor, Wes Gray runs portfolios that have perfect foresight, meaning you are buying the best performing stocks in the market, shorting the worst performing stocks, and rebalancing every 5 years. This portfolio would have compounded at over 46% per year. This performance is pretty much impossible to achieve and would require perfect clairvoyance, which of course nobody has. At least nobody I know. However, there were multiple periods of time when this portfolio underperformed the market, sometimes by over 50%. Ouch! I mean, any manager that underperforms the market by this much has a name. He's called unemployed. In one of our previous coffee hour episodes, we talked about how market efficiency seems to be a pretty sensible theory, but it likely does not account for market participant behavioral errors. In a perfect world with perfect market behavior, factors like momentum and trend following should have likely been arbitraged a long time ago. However, it's likely that because investors' emotions tend to get the best of them, these factor premia are still alive and well. And herein lies the key. Quantitative investing allows factor investors to gather factor premia while likely protecting them from their own emotions. If behavioral biases open up the path for factor premia, then creating models that take advantage of this premia is one sensible way to juice these returns. But then the hard part comes, and that is having the discipline to stick with the model. See, if one does not have the discipline to stick with these strategies, then one is giving into the very reason why one chose that model. Life is full of ironies. But so the name of the game really is getting to know how much of this pain you can take before giving up. In fact, I asked Alpha Architect co-CIO Jack Vogel how investors could go about building robust quantitative factor portfolios that could help investors stick with their investment strategy. Here's what he had to say.
When building quantitative academic portfolios, such as portfolios that are targeting the value and momentum factors, investors should be aware of any potential issues that could lead them to throw in the towel. One common issue of targeting factor portfolios is that, at times, the portfolios and the returns will be different from the market. For some investors, this can be uncomfortable and may lead them to give up on their factor strategies altogether, especially during periods of underperformance. One potential solution to this issue is to target both the value and momentum factors. Because these two factors are less correlated than other factors, usually when one factor is not working, the other factor is working. So holding these two factors together could help to minimize periods of underperformance as opposed to only holding one factor. In addition to holding both value and momentum portfolios, investors can also add a simple market allocation in the portfolio to minimize tracking error and help investors stay in their seat. Being able to stick with the overall portfolio is important for investors to reap the potential rewards that come with investing in quantitative factor portfolios.
Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.